called ASST, Do Not Sell. Here's why. In short, it argues for a speculative buy on Strive Inc., telling holders to, well, not sell. The whole thesis is built on the company's pivot to a Bitcoin treasury and a pending $500 million capital raise.
And it's a vibrant analysis. I mean, it really succeeds in framing ASST as this leveraged Bitcoin proxy, not some old marketing company.
Yeah, the conviction is there.
Definitely, especially with the technical read on that 90-cent floor. But, you know, when you label something high risk, high reward, you really have to dig into that risk side. It needs to be just as rigorous as the technicals. I agree completely. And that brings us right to our first point. It's about completeness and focus, rigorously defining the high risk, high reward. A more robust analysis, I think, requires a really dedicated, detailed look at the potential failure points in a transformation like this, rather than just, generalizing the downside.
Exactly. And the weakness here is that the risk assessment, it's just a bit too simple.
In the valuation reality check section, you mean?
Yeah, it correctly says, if Bitcoin crashes, ASST could retest 50 cents.
Okay, fair enough. That's a real risk.
It is, but it basically pins the entire risk profile on Bitcoin volatility. It just kind of ignores the huge operational and execution risk of turning in, $801 million market cap company into a Bitcoin treasury proxy.
Right. That reliance on a macro factor, the BTC price, it's necessary, sure, but it's not the main risk that's specific to AST.
No.
We're talking about a complete corporate overhaul here, funded by this massive and frankly complex capital injection, that $500 million Santata preferred stock offering. The real fragility, it seems to me, is in the execution of the pivot itself.
Absolutely. If the bull thesis is all about successful execution, deploying the capital, becoming the proxy, then the failure thesis has to be about the failure of that execution.
And we really need to talk about that financing. Preferred stock, especially something this big, it's not like straight debt. It carries different risks, dividend obligations, restrictions, and crucially, dilution.
The report frames the funding as this massive catalyst, but we need to see the structural risks of the catalyst itself.
I think the suggestion for improvement, then, is to strengthen the material by dedicating a whole subsection to execution risk.
Yes, to really address the specific vulnerabilities of a company going through this kind of change, especially when it's all riding on this new, complex financing. It just shows the analyst has really wrestled with the downside.
That adds so much rigor. And for a concrete example, you could, say, analyze the structure of the $500 million SATA offering itself.
Yeah, what are the dilution risks?
Exactly. What are the failure conditions? What's the time frame for deployment that if they miss it, just erodes all investor confidence? Investors get Bitcoin volatility. What they need to understand is the structural risk of this vehicle.
That's the key difference. It shifts the focus from the external market to the internal financial engineering. It's about the process, not just the outcome.
And we can't forget the legacy business either. The report calls it irrelevant for revenue, which might be true, but what about liability?
That's a good point.
So another approach could be to model a scenario where that legacy business creates some unexpected drag, regulatory issues, cleanup costs, whatever.
Even if it's a small chance, just having that comprehensive downside makes the final speculative buy so much more credible. It shows you've really stress-tested the idea.
Agreed. So if we've established that execution is key, we now have to look at how the report justifies the reward. That takes us to the heart of the bull case, right? Which moves us to our second point. Angle and originality, substantiating the MicroStrategy 2.0 comparison. To really elevate this from a compelling story to a definitive report, that direct comparison to MicroStrategy, it needs specific evidence. It has to justify why ASST should get a similar trading premium.
The analysis leans so heavily on the MicroStrategy playbook. It links ASST's goal of maximizing Bitcoin per share directly to MSTR's success.
Which is great narrative packaging, it really is.
It is, but it makes that parallel without detailing the huge structural differences. MSTR was an established software company using retained earnings and low-interest debt. ASST is pivoting from what the report itself calls a failing marketing company.
And it's using a $500 million preferred stock offering. Totally different ballgame. The idea that ASST will just automatically decouple and track Bitcoin needs way more substantiation.
That premium is the holy grail of this trade, isn't it?
It is, and you have to justify it. Why would the market give that premium to this complex equity structure when it gave it to MSTR's much cleaner debt structure?
So the suggestion to fix this is to add a brief, focused comparative analysis.
really justify why the MSTR dynamic should apply here and focus on those structural differences.
You need to show that ASST's financing, the SATA preferred stock, offers comparable or maybe even superior efficiency compared to MSTR's debt strategy.
Yeah, the material could include a high-level comparison of the capital deployment mechanisms. Contrast the cost of MSTR's debt versus ASST's preferred stock. If you can show it offers similar leverage, then you've earned that MSTR comparison.
Right. If this stock is non-dilutive for a time, or the cost of capital is actually lower than what MSTR had, then that's a massive tangible bullet point. You have to spell that out.
It moves the comparison from just a strategy analogy to a real financial thesis.
But what if the cost of capital isn't better?
Then we still need to justify it somehow.
Then you pivot. You pivot the argument to an originality angle, not just imitation. You could detail why ASST's current valuation, under $1, makes the decoupling potential different from MSTR's path.
Okay, I see.
Maybe you emphasize the low market cap dynamic as an accelerator. Instead of just saying it is MSTR 2.0, you argue it's a faster, more explosive version because of its starting point.
So you turn the challenge into a feature.
Exactly. It lets the report stand on its own and argue for a unique market dynamic, not just copy a blueprint.
Okay, that makes a lot of sense.
Now, let's talk about structure. Because even the best thesis can fall flat if it isn't presented well, which leads perfectly to our final point. Significance and relevance, pinpointing the immediate market catalyst for the sell-off. Yeah, to strengthen the flow, the report needs to ground that initial 7.82% drop in a concrete fear, a fear that the rest of the analysis then directly refutes.
The structure is pretty solid, but the executive summary just dismisses the drop as short-term volatility. And while the technicals on the 90-cent floor are good, the report never actually names the specific market concern it's dismissing. It makes the rebuttal feel a little less precise, you know?
But do we really need to name the specific fear? I mean, isn't generalized volatility enough to set up the rebuttal? The report is about looking forward, right?
I see what you're saying, but yes, I think the specificity is structurally crucial here, for maximum impact. If the drop was because of, say, confusion over dilution from the preferred stock, the report should just say that.
Okay.
By keeping the cause generic, the rebuttal feels a little abstract. It's like a solution without a defined problem.
Ah, I see. So by giving the fear a name, dilution, execution anxiety, you set up a target.
And the rest of the report becomes the definitive proof that demolishes that specific target. It just tightens up the whole structure.
That's the goal. So the suggestion is to structure the very beginning to briefly acknowledge the most likely cause of the sell-off before you deploy the bull thesis. It sets up the whole narrative as a direct counter-argument. And it's a simple fix. Instead of a vague opening, it could start with something like, the 7.82% drop was likely fueled by skepticism over the execution speed of the Bitcoin buys, or concern over the merger specifics. Right. State the fear, then immediately pivot to refute it with the evidence, the war chest, the technicals.
This modification makes sure all those strong points are read as direct, evidence-based answers to a specific, defined market doubt, not just general panic.
It makes the whole thing feel more like a powerful argument. You address and defeat the opposition's core claim right at the start.
Okay, so to wrap up, this analysis is already high quality. The core idea that you're buying a leveraged Bitcoin proxy, that is a brilliant encapsulation of the thesis.
Oh, absolutely.